Now let's look at efficiency reports. There are different types of efficiency reporting, but some typical ones look like a budget statement, a project report, daily operations report, and what I'll call a RevPar report. The budget statement. So staying within budget statement is especially important. Our first task is to ensure that revenues reach the expected level and that expenses do not exceed the projected amounts. The budget statement includes things like key budget classes, amount of projected revenue, amount of projected expenses, the projected budget overall. And then as we go further into the fiscal year, we'll look at actual revenue and expenses and percent of budget expended to date. So here we have a budget statement from Pine Creek Resort. So this is going to be a mid-year budget cycle. So we can see at 50% of the budget period. So if we look at revenue, so we expected a revenue of $120,000 from guest service assessment. We're halfway through the budget period and we've gained $60,000. So we've gained about half of what we expected. And you can see that to the right with the 50%. And we have a balance. We expect $60,000 more dollars to come in. Then you can look at things like personnel down in expenses. So we budget $108,000 for personnel. We've spent $42,000 and we've got $2,000 more committed that is going to be paid out real soon. So overall, we've expended a little over 40% of our budget for personnel, and we're 50% through the year. So we're doing pretty good. And we have about $64,000 left in our budget as far as what we estimate to spend. But overall, we're ahead. So if you look at the percentage there in that column, you can see that 50% is where we're at as far as the fiscal year, and things that fall at, below, or above. So if we're at 50%, we're doing right on track. If we're below 50% in revenue, that means we need to make up some stuff. If we're below 50% in expenses, that means we're doing really well. We're saving money. Then if we're above 50% in revenue, that means we're doing really well for the first half of the year. If we're above 50% in the expenses, that means we're probably spending too much money on that individual item for the first half of the year. So the budget statement should include a percentage of the budget spent to date, a percentage of revenue to date. The expenditures and revenues do not accrue equally across the year. So think of that like busy and slower seasons. There's a lot of seasonality in that function or that equation. So we need to compare projected and actual revenues and expenditures for specific programs or events for recreation, right? So this includes commentary that helps future organizers with the program event to understand the financial success or failure of a project. So if we think about fall soccer, the main revenue is going to come right before the season. So if we look at it as an annual thing, we're going to think, man, we're not doing so well in early or late spring, early summer, because we're just not getting any of that registration money in. Well, that's natural because we're going to get that registration money in as it gets closer to the actual league or tournament time, right? So that's what we need to look at. So let's look at a project report regarding the budget. So this is going to look at the Frosty Frolic. It's a snow pitch softball tournament. So it's a softball tournament in the winter. So if we have a projected budget of $1,000. We have $500 in corporate sponsorship, $800 in fees, and we're going to make about $1,100 in concession sales. So our total revenue projected is going to be $3,400. Now, if we look to the right, what we'll notice is we spend a little bit more. We got a little bit more revenue in corporate sponsorships, and we got a little bit more money in concession sales. So we did better. So we actually had a net gain from the projected budget to the actual budget as far as revenue goes. So we looked at revenue. Now let's look at expenses related to the snow pitch softball tournament. So as you can see, we've got the in the middle column, we should have the projected expenses, and on the right we have the actual expenses. So you can see some differences across that. So we've got publicity or administration changed. So our actual expenses were lower than our projected. And our equipment purchases were actually higher than projected. And then we had facility fees were slightly up. Kickoff reception was slightly higher than we projected, and so was insurance. So as you can see at the bottom line, we've got a much more higher expense than we anticipated. So we're looking at 3360 versus 3590. So overall, we originally projected to have a net gain of $40, and we ended up with a net gain of $210. So overall, we had a net gain because we did so well on our revenues. So in the hospitality setting, we also have what we call a daily operations report, and it's a summary of the business conducted for that day. It's often used by the general manager or whatever supervisor is filling it out. And it's basically to review the overall operations for that day as far as cash exchanges, any expenses, and revenue for the day. So here you can see an example of a daily operations report. So you can look at what today, as far as what we have available, occupied, so on and so forth, down through there. And then we can look at the month to date and year to date as far as what we actually had, what we had budgeted, and what was used last year. Then we have another one that hospitality settings rely on heavily. It's called the RevPar. It's revenue per available room. So they rely on RevPar quite a bit. It's usually expressed and discussed as an annual average, but it can also be calculated over a shorter period of time. So if we can look at an example of this, if we have a birthday resort and lodge with 300 rooms, on average, a room sells for $200 per night, and we have an average occupancy rate of 74%. So this is how we calculate the RevPar. We go the average daily rate, $210, times the occupancy rate, which is 0.75 or 0.74, excuse me. And then we have the RevPar is $155.40. So that's the revenue per available room. Just remember, the manager must have a basic understanding of accounting principles and practices across the board, whatever your situation may be. And this is to effectively and efficiently manage the financial resources of the agency or organization. You want to make sure that you're doing the best and being a good fiscal steward of the resources. And that concludes our presentation on efficiency reports.